Well, good evening, everybody, and welcome to the April 2021 edition of the Roundtable. My name is Mark Robertson. I'm joined here by three dear friends, Kim Butcher from Florida by way of Indiana. Good evening, Kim.
Good evening.
Hugh McManus joins us from California. Now, he's probably muted and running around for sound equipment, but good evening, Hugh. Glad you could join us.
Good evening, Sir Knight.
And last but not least, certainly not least, our raconteur from a few miles to the north, Ken Kavula, also joins us this evening.
Hi, everybody. Glad to be with you.
And we were debating before the session got started if that could be Punxsutawney down in the valley there, or could be a lot of things, but I'm thinking maybe New Zealand. Could be. All right, well, welcome, everybody. This is our, we're coming up on 11 years of doing these monthly webcasts where our intent is quite simple, to travel like those characters on the lower left there and discover opportunity and share ideas. That's what we do at the Round Table, and I'm grateful to have so many people in this community that go along for this wonderful excursion. Thanks, everybody. We'll go ahead and get underway here. We'll start with the legal paperwork. No investment recommendation is intended. These sessions are all about education and the demonstration of a philosophy, a method, or technique that has been perpetuated by the modern investment club movement for nearly 8 decades now. So everything is about illustration and demonstration. Everything you will hear from the four of us will be opinion, but we are sharing ideas and methods. We do try to disclose when we own a stake in a company that we're discussing. And if you'd like to be added to a reminder list about this event and other similar educational events, send an email to nkavula1@comcast.net, and you'll be added to that reminder list. And if you'd like a copy of the slides, or if you have follow-up questions, please feel free to send an email to markr@manifestinvesting.com. All right, so let's go ahead and press right into it. Here's kind of our standing agenda for these sessions. Again, if you're new to this, we do try to keep it fairly informal. We'll just kind of crunch through the stock presentations, spend a little bit of time talking about a discussion topic. We do keep track of the results of the stocks that we bring and have been bringing for almost 11 years now. And we'll talk about that a little bit. You can see the 4 tickers that will be involved in tonight's discussions: Regeneron, DXC, Gilead Sciences, and A2 Milk. We'll wrap it up. We do have an audience poll after the 4 stock presentations. Even if you are brand new here, you are heartily invited to participate in that poll. And then if there's some time left over, we will do open Q&A. Any comments or questions, Ken?
No, I think everything's going fine in the back room right now, Mark. So, folks, please, if you want to raise your hand during the event, do that, and I'll try to get to you and unmute you so you can speak. And if you don't want to speak out loud at this session, please use the questions box. Put your questions there, and again, we'll try to answer as many as we can during the session. And if we have any time left over, we'll stick around for 10 or 15 minutes and try to get to as many of the unanswered questions at the end of the session as we possibly can.
Or until the Jameson runs out. Just kidding.
Right.
Just kidding. Just kidding. Just a quick summary. We've been doing this, like I said, almost 11 years. Our idea is to basically share an idea. For further study, please do your own homework. Don't run out and start a transaction simply because you heard us mention a ticker. None of you would do that. We do encourage non-core selections. We'll be talking more about that in a minute. We keep track. We want to beat the Wilshire 5000 by 5 percentage points over the long term. That's what the relative return is. We'll show that to you. And we do like over half of our selections to actually outperform the Wilshire 5000 after we make them. Here's a quick look at the performance. And again, I think it's time for a water cooler, cyber water cooler. High five, everybody. We have returned to the 19.3 level when it comes to the internal rate of return, that 19.3, when you compare that against the Wilshire 5000, making mirroring or matching investments into that, the rate of return on that right now would be 13.5. You subtract the 13.5 from the 19.3 to get the 5.8. That is the relative return, and that's what is depicted right there. The red dotted line is basically the type of objective that most investment clubs and many individual investors have, basically an attempt or a goal to beat the general stock market by 5 percentage points over the long term. And it's fun when you're doing it. If you're anywhere on that page, you're doing fine. Even in that, towards the lower end, just keep improving and learning and all kinds of good stuff. Any comments or questions, Ken?
It's phenomenal, Mark, that we can maintain this number as high as we've been able to do, and do it with some fun and folks that don't spend their whole lives dealing with investments either. We have some very smart people that we bring in for their opinions, but none of us are professional money managers or anything along those lines.
Yep, it's a powerful community, and we hope to continue chugging along at those levels. What I thought we'd do for a minute, just for kind of a reinforcing topic, is talk just a minute about the selling strategy that we deploy at virtually every meeting. We've kind of turned this up over the last few years of the roundtable with some general house cleaning, but it's in search of the answer to the question, do the guidelines, the process that we follow, generate better returns? And I'll just kind of click through these real quick. The number one reason for making a sell transaction in any portfolio, and certainly for the round table tracking portfolio, is to improve the overall portfolio. Typically that means selling a company with a low return forecast or PAR, that's projected annual return. And the rules are right there. We sell a core investment if we drop down to money market rates on the return forecast. We sell non-core if they begin to approach average return forecast. Right now, that would be about 5%. Money market rates are pretty close to zero. We'll call it 1% if you'd like. And then we have been trying to do a little bit more diligently on when quality degrades at a company, to use that as a reason to sell. But we haven't done a whole lot of that, Ken. It's something that hopefully we can ratchet that up a bit. Maybe develop some metrics that can assist that effort.
Our tools to deal with quality degradation, we can do it in individual stock by stock basis, but that becomes kind of tedious when you have a portfolio as large as the roundtable stocks. So I agree that if we could come up with something to track quality on a basis and tell us when it drops 10 or 15 points, that would help a lot, you know.
Yeah, and we basically need a first derivative or second derivative, and we don't need to go into that. But it's something we'll pay a little bit more attention to. Ken has written a few things about it here over the last couple of years, but we'll keep going. The concept that we did introduce within the last few years is this notion of the rule of 5, and a timeout being applied to stocks that are not meeting our expectations. And that timeout, that's the same one if you have children or grandchildren, where they just simply have to go off to the side and take a little time out. And what it refers to is if we pick a stock and it basically lags the market by more than 20%, and that's not a hard number. It's a flexible number with some nuance or flexibility to it. But what we have found is that it can be quite a protective measure. And when you think about it, you know, you can do 5 awesome stock studies and things go wrong about 20% of the time. So if you want to take advantage of that, we're going to show you a case study. It's our poster child case study on iconic brands, but it can actually keep you out of a lot of trouble from time to time. And the third thing we check basically every month is we watch for a stock that has really been on fire. And what happens is the relative strength index, RSI, you can Google that and read up on it. But when the stock price momentum gets extremely high, and many of the professionals use 70, we like to use 80 after a series of studies and discussions with some people last summer. And again, we believe in Roman candles. We think, we think of a stock that you buy at 10 and it goes up to 90 and you don't get out of it. And the next thing you know, it's selling at 20. So Roman candles are a real thing. So I think, as Ken said this afternoon, the magic word there is consider selling. Wouldn't you agree, sir?
Absolutely. It brings it to mind, and it makes us stop and ask the question, why is it so oversold? Is it pure momentum? Is there something behind that momentum that we're missing? What's the problem here? And sometimes there isn't a problem, but sometimes the money's just kind of being handed to us, and we'd be silly not to take that money, thank the stock for giving it to us, and then move on and reinvest it in something that has a lot more potential attached to it.
All right, so we're going to take a look at a couple case studies. Here's the one that we've talked about a number of times at the Roundtable, Iconics brand. I actually did the study back in April 2015, so about 6 years ago. And that very evening, you can go back and listen to the transcript or listen to the YouTube video. I talked about how although it was a fantastic study, one of the best we've ever seen here at the Roundtable or, anywhere on planet Earth, did admit that it came with a little bit of the heebie-jeebies, that instinct or feeling you get sometimes. And I actually said the words, if this thing lags the market by 20%, we're going to walk away from it. That timeout that we've been talking about with the rule of 5. So sure enough, fast forward 3 months later, the stock we had bought for $263, that's split adjusted, it actually dropped down to $200 during a relatively flat market. So it was 20% behind the market. So we took our $800 and walked away. So the $800 was preserved. And then, of course, the next question is, well, what if you just had not done that and hung on to it? Our $1,000 invested in April 2015 would now be worth $7.60. So our argument is you do that a few times, it can really dramatically affect your investing experience. So we've had a few of these that our behinds have been saved by this very notion. Now, one other thing I do want to point out, and I pointed it out this afternoon, is I don't think I was completely wrong on this one, because if you go back to right here, it actually went from 62 cents up to almost $5 in 3 months. So I was just early.
Mark, we are getting a couple of questions about where do you get charts like this one? And I think the next chart will also apply about where do you get it. There's a couple of sites online that are free, at least at the most basic part, and either bigcharts.com or stockcharts.com. And you can make these kind of comp charts where they're comparing against MA up in the corner there stands for moving average. You can compare against some different technical computations, or you can also put a couple of different stocks on the same set of axes and compare them one to another as well. I think Mark's going to show us the next slide, and he's going to show us an RSI, and we've had a couple of you, oh, not quite yet, okay. But he is going to show us an RSI in a couple of slides where you can also add a second chart to these big charts or stock charts, and that would be RSI, stands for Relative Strength Index. So again, bigcharts.com, stockcharts.com. We're going to have to do a feature on those again in the next couple of months, Mark,
And Yahoo works too, Finance Yahoo.
Yes, you're absolutely right.
So, if this would,
maybe have a list of our favorite websites.
yeah, we could do that. We will do that.
Yeah.
Maybe that's something we can do for the session coming up in a few weeks. So here's the case where it actually went crazy to the downside, and here's the opposite side of that story. In fact, this was a selection by Ann Manning. Ann's here tonight with us. Ann, for the Roundtable, selected Adobe back in July 2011. 10 years ago at again split adjusted price of27.71, and had a heck of a good run over a period a little over a year. where the stock price got up to 42.97, and we agonized over the decision and did sell it at that point. We'll take a look at a few slides that explain why we sold it. But here's a situation where we were selling it for that portfolio-centered reason of it had the lowest par in the portfolio at the time. And sure enough, that $1,000 had become $1,550 and was beating the market by 16.5% at the time. But if we had just simply not done that sell transaction, that $1,000 today would be worth $18,611. By the way, we have over 1,000 transactions for the roundtable over the history of the roundtable. That would be the single best decision, going up to 18,600. Pretty cool when it comes down to it. What I thought we'd do is take a quick look at, why did we make that decision? In fact, Ken, if you'd like to kind of walk through this one, it's a decision we agonized over,
Well, we have been focusing on growth, on sales growth, and that's that column almost in the middle of the dashboard right there. And we wanted our growth to be a little bit stronger. We wanted to kind of push it up towards 11.5% if we possibly could. And the classic way to push up growth is to sell something that is growing more slowly than the number you currently have, and then that will push the average up. In retrospect, Monday morning quarterbacking, you look back and you say to yourself, well, why in heaven's name didn't we go after the 2.7 grower rather than the 8.8 grower? The 2.7 grower represented more than twice as much of the portfolio, 5.2% of the portfolio. I'm looking at the number right next to it to the left. And the 8.8% grower was only 2% of the portfolio. I certainly could have impacted that 10.2 a lot more strongly by selling the slower grower that was a bigger part of the portfolio. Well, for whatever reason, we did not do that. And on top of everything else, you look over in the bottom right-hand corner and you notice that the par in the whole portfolio was green. Well, that green means that it was signaling to us better than 5 points above average. It was in the sweet spot. That would be 5 to 10 points above the average at that time. We really didn't need to worry about anything because our par was sitting in a pretty decent place. So again, from a Monday morning perspective, we didn't really have to do anything with Adobe except just sit there and let it make some more money for us. Probably would have been a better decision, but we haven't made that many of this kind of decision that we're going to take and throw away all of the other guidelines we've been talking about. Mark's going to show you some numbers in just a little bit that might surprise you a little bit, but when it's all said and done, you just have to accept that you made a mistake and go on. That's all.
Yeah, and one last comment.
And in fairness about Staples, because I was the one who had loaded up on Staples, personally as well, I would have kicked up, and I think I probably did kick up a hissy fit about Staples, because I figured the government would recognize that who they had identified as the competitor of Staples, they wanted to merge with Office Depot or Office Max, I can't remember what, they were blocked. And then they had another go at that, and I figured, well, they're going to let them because they're not really a competitor. The competitor of Staples is the online business, Amazon at the time. But no, they wouldn't allow them to they wouldn't allow them to merge. So
Quill.
Quill at one point was the second biggest online retailer in the country.
Yep.
After Amazon.
Unbelievable.
Yeah.
Well, and then just one last point on this, and it's again, it comes down the lines of patience and kind of sticking to discipline. Adobe Systems at a 3% return forecast, that's well above money market rates even back then. So I think that's what Nicholson meant when he said, when you've got a growth company in your portfolio, give it a long leash. And, wait for that return to be actually pretty close to zero, certainly below money market rates. Here's some of the other information that was available to us at the time.
And in all fairness, Mark, we've gotten much better reminding each other about what we're trying to look for and about keeping ourselves calm every meeting about selling things, not just immediately pulling all kinds of trigger and throwing them out of the portfolio.
Absolutely. That's where there is strength in numbers. So what you're looking at here is actually two transactions. The first one's Ed Manning's nomination back in July, and then a few months later, Ken actually selected Adobe again. And you can see on the Chronicle those points in time when the return forecast, the par was up in the, relatively a high period here. So it was looking pretty good. That all came to fruition, and that drives the return forecast down. So this is working. It was definitely working. Here's a look at the price charts at the time those selections were made, and they just bear out that both of the selections were made. They beat the market, and here's the bottom line of the story, though. Before we move on with tonight's agenda, here's the answer to the question: what if we simply ignored those challenge disciplines and just bought and held on to them forever, only selling when a merger or an acquisition takes us out? And what you see here is about a 16% return for just not worrying about a selling discipline or the stuff that we've been talking about here versus our 19.3. So that difference is actually quite massive over the 11 years of about 3 percentage points. That's a massive difference.
Per year, Mark. Yeah, per year too.
Yeah.
That's a yearly number that we're looking at, not a total number.
All right. Any final thoughts on that, Ken?
No, I think we're ready to move on and maybe move into our stock presentations.
Well, just real quickly, let's talk about the portfolio. We don't have many actions tonight. Basically, here we lay out the round table tracking portfolio. We do have it split into two halves, core and non-core. The way we define core and non-core is up at the top there. And you can see that it basically adds up to a situation where we've got enough growth, decent quality, and this par is actually really close to the sweet spot of 10.3. So we're not in any hyperactive mode to take any corrective action. You can actually find the roundtable tracking portfolio. This is the core part of the portfolio. You can find it at this link up here. This is the number of times selections have been made. So for example, Cognizant Technology has been selected 15 times. So $15,000 has been invested in Cognizant. It's now worth nearly $29,000. This happens to be the top 20 holdings in the roundtable core tracking portfolio. And again, you can take a look at that at your leisure. And then here is the non-core part of the portfolio. This is the entire non-core portfolio, along with how they have been doing. And we are quite happy with Amazon and Ardelyx. BP and United Airlines are behaving pretty well too. And pretty good run for all of these. Any comments or questions, Ken?
I just am watching Universal Forest Products, which we've only chosen twice and relatively recently, and it's already up to $3,300. That's pretty exciting.
Yeah, have you tried to buy lumber lately, Ken?
No, but I've been watching some of the prices. Yeah, I'm hooked on some of these remodeling shows on the HDTV, not HDTV, the
do it yourself, right?
Well, it's do it yourself kind of stuff. Yeah.
Yeah.
Those shows are dangerous.
Well, I really am hooked by a number of them. I like the people. I like what they're doing with the homes, and I just don't want to open up the checkbook for as much as they want to spend to redo parts of my house. That's all.
Keep spending my inheritance. All right.
Yeah.
Here's the challenge for tonight. These would be the companies that meet those sell disciplines that we talked about a few minutes ago. The ones on the top are from the core portfolio, and they are the ones that have the lowest return forecasts. Right now, that would be Booking, Texas Roadhouse, and EPAM Systems. They're all on quite a good run. None of them are down to money market rates, so I guess we should follow our Adobe advice and just kind of look the other way. We'll take a closer look at Booking. And then A2 Milk, you see the cow. That one is not behaving very well. And believe it or not, I not only don't want to sell it, I want to buy it tonight. So I think that overrides any selling decisions, right?
Okay.
Okay.
My only regret is that we only bought Texas Roadhouse once, you know?
Yeah, exactly. Here's a
I
quick
see you
look.
herded the audience into it as well.
I did. They're part of. There is the audience and I are unified on this.
Yep.
Good stuff. All right, here's a quick look at booking, and I don't think this is a surprise to anybody. COVID has just massacred these guys, but we call that the chasm, and the chasm does have another side. And I really think that, a projected return of 6%, the projected return on value, we'll talk about a little bit when I get to my selection of the milk company. I would not hurry to sell this company from the tracking portfolio under these conditions. The chasm is what the chasm is, and this will something like this is going to happen.
Plus, Mark, I think the analysts are all over the place on some of these reopening stocks. They can't quite figure out where they want to start their projection from. They can't quite figure out where they want to end the projection, and it just it's making no sense. Some of these numbers, the differences in ACE numbers are so wide that the average is becoming, in my mind at least, a little bit meaningless.
It definitely. Yeah, there's some weird.
Isn't it interesting that when you're forced to have to think things through, how disparate the views get?
Yep.
Absolutely.
Yep. I guess, Hugh, are you saying when the company doesn't tell you what the numbers should be? Is that
there? You go.
Okay.
They call that statistical scatter when they actually have to work.
Yeah.
All right, and just a quick moment here for the A2 Milk Company, since it is on the hot seat. They are having some rough times. Stock price is down, and like I say, we're lagging the market by 48% since we first originally picked it. I would encourage you to take a look at this monster, the story of the monster next door, to basically lay out the larger picture story for A2 Milk. And the core question that I ask is, has the thesis changed? The thesis of being potentially a good nutritional product with a lot of opportunity for geographic expansion. I'll talk about that later. My one-word answer is, I don't think so, with a bunch of hyphens. Not yet, at least. So that's kind of where we're going on that. All right, so with that, Ken, I think we can go ahead and launch into Regeneron.
Well, I'm going to keep this real short and sweet. Cy and I both picked Regeneron within the last couple of months. We both felt it was a real strong candidate. In my opinion, hasn't changed too much. The share price has gone up a little bit since our first pick, but not significantly in the short time that we've had. That will change a lot of the numbers. If you go to the next slide, Mark. I did take the core portfolio, and that's what you're looking at right here. I'm sorry, the non-core portfolio I'm looking at. Am I looking at the non-core? Yes, no, yes.
No, it's probably.
And go on, Mark.
Yeah, I think it's the core.
Okay, it is. It's Adobe. It's the core portfolio. Okay, and I sorted it by par. I like to buy for the portfolio right around the place where the sweet spot changes to maybe too good to be true. That's the green numbers changing into those orange background numbers. But I look to the top of Regeneron and to the bottom of Regeneron. I like both of these companies a lot, Universal Display, and I like Adobe, both of them. But look at the PEs that I would have to work with if I was going to get par values equivalent to the par values that the ACE numbers are giving us right now. I'd have to move PEs up into the 70s for Universal Display and into the 60s for Adobe. Meanwhile, for Regeneron, I'm dealing with a PE of 16, which gives me a par value right between the 14.5 and the 15.7. So I'm pretty comfortable with choosing Regeneron again right now by my method. I did go to the biotech area where Regeneron's classified, and I noticed that by manifest rank, Regeneron was #1 in that particular industry as well, followed by the 4 that you can see on the chart at the bottom right there. Next slide, please. I'm not going to speak again about the robust pipeline, but that's something that every single article that you read about Regeneron makes the point over and over and over again that not only does this company have a large number of drugs in phase 3 trials, but it has a lot in phase 2 and phase 1 trials right on the heels of the phase 3 drugs. And there's a lot of optimism about a fair number of these types of things that are running through the phases right now. So the pipeline is very robust. You see some of the blockbuster drugs at the top up there, and I'm sure that we'll learn the names of some other ones from this list in the next 5 or 10 years. Next slide, please. I like the fact that Regeneron has a very strong presence in some of the newer types of technology, in some of the newer types and approaches to coming up with biologics and coming up with new drugs. You can read all about it in their investor presentations. Here's 4 things that they kind of highlight as being on the cutting edge of technology to develop these new treatments, and I think we should be aware with a number of them. Hugh did a nice job talking to us about CRISPR just last month and what exactly it was, and there's some other types of technologies that are really quite novel and quite different from what's been going on in biotech for the last X number of years. Next slide, Mark. I'm especially telling you that the press is just in love with the 2021 regulatory submission for Dupixent as a pediatric asthma medicine. I must have read a half dozen different articles telling me that this was going to completely revitalize the drug Dupixent as far as being a big moneymaker for Regeneron. Because pediatric asthma is one of the most common problems that we have medically with children throughout the world. So there's just a lot of press optimism about this particular submission. Now, whether they will all come to bear, I can't say. I don't know of anybody that can. But the folks that are supposed to be knowing about it seem to be quite optimistic about this one particular submission. Notice there's a COVID submission at the top. That's the COVID-19, and that's not a vaccine. That's their therapeutic that they can use within the hospital for COVID-19. Next slide, Mark. The lines pretty nice, up, straight, parallel. This is when the company basically has brought itself to a place where if I knock off those 4 years, I can get the trend lines to underlie the data for the last 6 data points pretty nicely. That gives me growth rates of 16% for sales and 40% for earnings. And I think that I'm being extremely conservative when I use 10% in both of them. That 10% seems to work real nicely with the preferred procedure. If you start with 10% sales, you end up very close to 10% earnings. And I like that when they seem to track fairly evenly with each other. I also noticed that Regeneron is not trading near the top of its range like an awful lot of companies are right at the moment. Next slide. Here's the back of the SSG down through most of section 4. I've used PE values that are at the averages after I've struck the 2016 and 17 numbers, which were extremely optimistic in my viewpoint. The last 3 years have been clustered much more tightly, and I feel they represent where the company is moving as far as PE values are concerned. I get a good solid buy, 6 to 1, a little bit better than 6 to 1. Next slide, Mark. This stock does not pay any dividends, so there's no payout ratio, but I am getting a 12.3 to 17.6 number. I think that squeezes in real nicely to Mark's number of around 14% coming from the analyst that he puts the numbers together for. So all in all, I think we're looking at a stock with a very decent potential going forward and a relatively low PE value to meet the bar of success for. It doesn't have to reach up into the stratosphere to get a PE value to be successful. We're looking at PEs in the upper teens, lower 20s to get these kind of numbers. So I'm pretty pleased with this. I do own this stock in one of the portfolios I manage, and I'm quite happy with its performance. There's that 14.6 coming from Manifest Investing down at the bottom of this slide.
All right. Thanks, Ken. Let's go ahead and go with Kim on a little trip through Cy's favorite hunting grounds, the information technology and services companies.
Yes, I'm going to present DXC, and it closed today at $31.67. It's a technology company, gives information and solutions primary to North America, Europe, Asia, Australia. It has segments of the global business services and infrastructure. Next slide. Okay, this is one that, if you look at the, it's a roller coaster, but this is a turnaround story. And the turnaround, this was a spin-off between CSC with a merger with Hewlett Packard HPE way back in 2017. That's how this company was formed. And basically, it just didn't do well at all. And the management team decided that they needed to get new management in there. They had too much debt. So they got Mike Salevo in September 2019 from Accenture. Accenture is another competitor in the same space. Now, the part that's really interesting here is at Accenture, he was there from 1987 to 2000 and 2006 to 2016, becoming a group chief executive of Accenture operations, where he oversaw their comprehensive portfolio of business process services as well as its infrastructure, security, and cloud services. So in other words, they found a guy who had a background and history of success in this area. Now, he accepted the position to be CEO, and he has golden handcuffs, and I will explain that here later. Next slide. Now, here you can see this chart I got off from Yahoo. You can see where he was appointed the CEO in September 2019. You can see how the stock price had been as high as 90 and basically in a free fall. COVID starts, you can see where that started up and then how it went down more, and then it's been gradually creeping back up. Next slide. Now, so what's happening here? Basically, because you have a new CEO and they added a new chief HR officer and a new global delivery guy, and they're all from Accenture. That's where their history is. But this new CEO, he's the catalyst in this company in turning it around. They had customers that were getting forgotten. So he's gone in and talked to their customer base, and he has gotten them to sign up for more business. He's stabilizing the revenues. He's delivering for the customers rather than before where they had no follow through, and he's getting more work from them. That customer success stories is giving them the confidence that they will be getting the revenue stabilization that they need. And they've been cutting costs, and they've been selling off different divisions that don't work with their core competency. They sold off last year a $5 million company that their state and local health system services to Veritas Capital last October, and they used almost all of that $5 billion to pay down debt. Now they're also going to sell another company that $550 million of cost savings in fiscal 21 because they're going to be selling their healthcare software provider, and that will provide another area to be able to put more money towards debt. By doing this, they're reducing their costs and they're optimizing their program, which was their driver of the third quarter, which had their margin of 7%, and they plan on continuing expanding margins in the fourth quarter sequentially. So in other words, he's cutting costs, he's getting their clients back on track, getting them to get more business, and he's expanding margins. Everything that's good there. Next slide. Now, to show how he's been successful, they showed the point, and I got these from the PowerPoint that they gave out on February the 4th, that they're cross-selling to existing accounts and they're winning more work with new customers. As you see here, 55% of the third quarter bookings, which ended December 30th, were in new work and only 45% were in renewals. So they're getting customer success stories, and they plan on having more book to bill of 1 times or greater, which means when they book a contract, they're able to bill for it and they're able to follow through and not lose the customer. And the more they can keep the customer and to bill, the more success they have because they have more revenues. Next slide. Now the company are focusing on that finance and showing how they can focus on the free cash flow, and they're reducing the spending, reducing their CapEx, their excess facilities, overhead, and restructuring. They're starting to provide organic revenue. I love it when I see a PowerPoint from a company that they're saying that they're going to have disciplined capital deployment program, because you want to make sure you got a management team that has great capital allocation. And they're going to maximize that value creation of our free cash flow engine and that capital deployment alternatives, what they can do and how they can grow the company, which will give them improved financial visibility, because they had a whole heck of a lot of debt after that spin-off merger, and now they're bringing it all down. It's going to give them annual guidance and longer-term expectations on their next earnings call, and they're even going to hold an Investors Day, and that will be in the 1st of May. Next slide. Now, one of the things that they talked about in the quarter call was their revenue was not wasted because of cloud trends, and everybody thinks in the technology area, it's the cloud, it's the cloud. It was due because of the past management team, and some of the people still there had very poor customer service. And if you don't keep your customers happy, you're not going to get deliveries. Without improving those relationships, guess what? You're not going to have customers. Well, Mike has been able to definitely increase those customers' happiness. And as a result, it has ended up with more business for them, and as well as getting more organic growth. And as he said, that's within your control and it is fixable. Next slide. Now, okay, now let's get to the golden handcuffs. When he took this job, believe it or not, 90% of his compensation is tied up. When you see that round little circle there, he gets a base salary that's 9%, but the rest of it is a variable pay based on performance. His annual cash incentive is performance stock units because he has to meet certain performance benchmarks, as well as his restricted stock units for the future. He has to keep those, and they made it for the last 14A filing. I went to look at it. They're locked in for 3 years. So he doesn't get some of that payoff until he's met it through 3 years. So that's going to tie up shareholder interest and shareholder equity, so that when the company's successful, as a shareholder, you're going to be successful, and that's when he is going to be successful. They do have this, you know, short-term, long-term, but the thing is everything is reflected that he may get, he can't get all of his compensation until after 3 years. And that makes sure that you align your employees' interest to the stockholders, and that's what they want for their long-term strategy. Next slide. Now, this is the SSG that came from February 5th. Now, Mark, you've got that red pen available for me?
Sure.
Okay, I love going to that projections box. Look at that total annual return, 37% to 25%. If we can get 25% a year, I'm not complaining. I don't know about you guys. Next, look at the PE. 6.3, trailing 8.8, medium 11. That is a nice low PE. And now you've got a new management team that's been in effect since September 2019 to bring it about. All right. What they're projecting out for Value Line is revenues per share of $94, cash flow per share of $15.30, earnings of $8.50, and they believe they'll have dividends of 85 cents. Now, this company, when the CEO came in September, immediately he cut the dividend to nothing. He has not instituted anything back yet, so we'll have to wait and see what happens there. But this is my quick and dirty DCF that I've shown many times before. You take your cash flow per share of $15.30, subtract out the 85 cents of the dividend, because let's assume it is there. That gives you $14.55. You subtract out your $2, because every company has got to use some money to spend on building the company. That's $2, so that gives you $12.55. Up in the top left corner, you see that Legends box where Mark's circling it with red. It says 7 times cash flow per share. You multiply it by 7, and going out, that means 5 years out, the stock price could be $87.15. This is my fast and dirty DCF. Okay, now the stock closed today at $31.67. We want to have our money double in 5 years. If we get it to $87.15 in 5 years, we certainly have had a double. Now, if you also look at the projection box, the low price that they project out would be $70. The high price is $100. If you'll notice that $87.15 is where smack dab in the middle on the low side. Now, going forward, if you want to look on the far right-hand side again, notice how this company was riding high, and then everything started falling down, and you got the new CEO in September 2019. Look how the book value then was $18.87. They're feeling that that is going to at least more than double, because if it's going to be $39.40. I look at numbers. This is what the numbers are telling me. Next slide. Going forward, here we are to the bottom half of the Value Line sheet. If you'll notice, their operating margins were at 30%, went all the way down to 14. You get a new guy in there, it's gonna 18, plans on going up to 21.5. Profit margin was as low as 4.5. It's gonna double to 9. Return on total capital was 8. It's going to go to 15. You're seeing in numbers almost the same thing of doubles. And recognize this is a management team that's going to be able to turn the company around, is what I'm feeling, because they've done it before. They have a history. They've been successful. Next slide. Okay, here is the proof. You can see what value line has, that it could be at the high of a projected annual return of 33.8. We've got 21.6. That's much more conservative, but I think you're still going to make some money. Next slide. Just to let you know, I found this by Googling in YouTube Columbia Business School, because I know twice a year they have a stock challenge. This was the #1 stock from the Artesian International Value Investing Stock Pitch Challenge. What they do is they get these master's students. They may have 60 students who pitch a stock, and then they pick the top 4. Out of the top 4, this stock was picked as #1, and that presentation was done in January 25th of this year at Columbia Business School, and that's where I got the idea. So thank you for your time. I hope you'll consider this stock for your own portfolio, and it is a non-core holding.
All right. Thanks, Kim. Yeah, definitely a turnaround situation. All right. Speaking of non-standard companies, let's rev up Hugh and Gilead.
Yeah, well, Gilead would be as close as I've come in a while to a standard type of company. I mean, it does have earnings. They haven't been very consistent recently, but still it has them. So Gilead is a company I want to present, and I bought some of it last week. I'm not sure if it was the first or second time, but anyway, the process I have is I look for companies basically that are near their 52-week low. If it's a smaller company, I'd love it to be near a 5-week low. Sorry, 5-year low, a medium-sized company, a 2 to 3 year low, but 52-week low for a big guy. And while Gilead is not quite in the region I like, of 5 to 10%, it's close enough of the companies that I own that I'm going to delve into it again. And as I said at the bottom, all else being equal, but of course I'm trying to save Latin here, ceteris paribus, I will buy what I have bought before. And last week I bought Gilead, so I want to throw another log of Gilead onto the fire. Kind of reiterates what I said before. It is now an established pharma company. It has a broad range of indications that it is targeting. It is to some extent a victim of its own success with hepatitis C. This was an ailment that was discovered about 30 or so years ago. Globally, 70 million people have it, 2.5 million in the US, which is twice as many as are infected with HIV. It's quite widespread, and a lot of people were spreading hepatitis C without realizing it, and there was a huge effort to try to cure this, which is what Gilead went ahead and did through its acquisition of a company called Pharmacet. But it suffered for that. The stock price suffered, as we'll see in a jiffy, but it's continuing down that path and is targeting, as I mentioned last month, HIV, and has proudly said on its website now for at least a year that it believes it has cures, which is staggering to me. But if we skip along to the next slide, you can see the price has basically been flat for the last 8 years or so. Yeah, it looked gorgeous back in 2012, 2013. That's the time frame that it bought Pharmacet, which had very good clinical results with its phase 2B study with a hepatitis C drug. But when Gilead bought that for what at the time was an outrageous price of $11 billion for a company that had not been tried and tested, they obviously made bank with this, and the stock price shot up by 2015 to $120. It was the darling at the time of many NAIC/better investing folks. But since then, things aren't as good. It cured hepatitis C, and analysts didn't really know how to handle that. But if we skip along, what I want to show is the financial history of Gilead. in this slide, we'll show it for the last 6-7 years since it actually came up with a cure for hepatitis C and started marketing it. And I'll show a more recent one, but you could see how they trailing 12 months, this 4 quarters, so trailing revenue on the top, trailing revenue on the top, then quarterly revenue in the middle, and then it shows the year-over-year quarterly top line growth. And you can see what happened. It was doing really well. It was growing at a growing rate once it launched in 2013 or so, this hepatitis C drug. And by 2014, it was going gangbusters. That's when the stock price started to crater a little bit because people realized, one, you cured people, so they're not customers anymore. And two, doctors are warehousing patients because you can carry this virus for 20, 30 years without any problem. And they were warehousing the patients simply because maybe better drugs were on the horizon. You see what happened to the year-over-year sales from 2016 and on. But what has happened in the last 2 years, you can see on the bottom, is that sales have started to pick up a little bit. They cratered a bit in the second quarter of 2010, and that's a growth figure, not a sales figure, but it is trending. Now, you don't see that as much in the earnings per share, which is kind of flattish compared to the trend in the top line, but I think that's to be understood if the top line indeed is going to drive earnings in the future. So I'm a believer that Gilead is on the march. Certainly its pipeline is showing that. It has a new it has a new HIV regime that it has been selling quite successfully recently. And I think if we skip to the next slide, this is a grander scheme for the last 15 years, same deal, trailing 12 months, trailing quarterly, and then you can see what the growth in revenue looks like year over year on the bottom one, and that dip that happened when it cured hepatitis C got whacked for that. Then this comes from a website called macrotrends.net if people want to go and take a peek at that website. But skipping along, it has presented this last month, a great pipeline, very broad pipeline. It works its people to death. If you look at the number of employees that it has per drug, it's an incredibly productive company. And if we skip along, we can, I'm going to talk on the next slide about one drug that I think you have to watch, which is lenacapavir. It's an HIV drug. It targets the protein shell in the virus rather than trying to fiddle with the chemistry, because what it wants to do is it wants just to crack open the virus and make it not work anymore. And interestingly, we're in a world right now where we're all very cognizant and educated more than we would like to be about how viruses work, how they mutate, etc., and what mutations can do. HIV is certainly a virus that mutates, but what scientists have discovered is that this protein shell, once it finds a protein shell that works, it doesn't really tinker with that. It tinkers with the RNA in the virus itself, the molecule that it's going to deliver to a cell, to kidnap that cell and force it to replicate a protein or that it doesn't want to do, or that it's not designed to do. But the protein shell that surrounds it itself doesn't change over time. So they had the idea, why don't we attack that shell, crack it open? It'd be like cracking an egg. It won't work anymore. And so far, so good. It's in phase 2 right now, but it'll go into phase 3 soon. If we skip along to the next slide, there's,
Oh, sorry.
I don't see a number, but what's going to happen to Gilead, there's been a lot of talk recently that Gilead is going to be acquired. So it's either going to buy other companies, which it has been doing, or it will be bought. And it has proven to be a very adept acquirer of other pharmaceutical companies, and it will continue to do that. I cited the example of Pharmasset back in 2011, where it paid an outlandish $11 billion for a drug that had just come through phase 2B. It is an outlandish figure, but it turned out to be the right thing to do. And it continues to do that with its CAR T therapies, which Ken talked about a little bit for Regeneron. And the other option, if we skip to the next slide, is that someone will buy it. And the interesting thing about Big Pharma is risk averse. And Big Pharma will only buy Gilead if there is an uptick. And eventually, I'm a firm believer that the pipeline that it's working on now is currently showing an uptick and will continue to do so. And Big Pharma, being the conservative creature that it is, will buy too late. They should really be trying to force a purchase of the company today, but they'll wait way into the rebound when the stock price has reached 75 or $100, all driven by my contention that the pipeline will drive that growth in the next 2 to 3 years. And of course, then they'll have to pay a premium. So it's very likely that Gilead will be a stock that could be 100 to 150 bucks within the next 3 to 5 years. And I think that was it. There's just one slide where I just sum up that it has a strong history. It works. It's extremely productive, this company. Can't stress enough how productive it is. It has kept a small company mentality in what is now a large behemoth. It's very good at making acquisitions. It's proven that it can analyze companies very, very carefully, very, very accurately, and subsume them into its own culture and pipeline. And things do seem to be turning around. I think it is a merger target. It's an acquisition target. I don't know if and when it will happen, but I'm sure a lot of people are looking at Gilead very, very carefully.
All right.
So that is my 2 cents or $1,000.
Thanks. We'll throw another Gilead log on the fire. Thank you, Hugh.
Excellent.
All right, I'll go ahead and wrap things up here. I'll keep things relatively brief. Here's a quick screen capture of a screening effort, screening for stocks, where I basically went out and said, I don't really care about the quality of the company or anything else. I would just like to find companies that have really been beaten up, as it says below, recently punished. And you can do that by searching for relative strength indices, RSIs, less than 20 actually is where I want to be, but less than 30 is an indicator that they could really be oversold, undervalued. And here's a pretty good list of companies. Haemonetics could be a good study. Altasource, that's a Matt Spielman company from a few years ago that's pretty fascinating. PriceSmart, a good Caribbean, Latin America company that could be looked at. And we come to the company that we talked about earlier tonight, A2 Milk, that's on that rule of 5 potential sell list. I'm going to argue that we're going to do just the opposite. That is the company that I selected. We'll take a closer look. Emergent Biosolutions, I just want to cross this off so I feel better. Do you agree, Ken? Now,
I don't think you can balance the books that way, though, Mark, okay?
That means it's loathed, so we probably should be going in using Hugh's loathed index. They're just messing up the Johnson & Johnson vaccine, and Len Douglas sends me another article about their dirty factory, and I could go on and on. I'm not going to. This IRTC is another good, interesting one that has shown up in a couple of people that we respect portfolios, but for now we're going to go with the cows. Those happen to be New Zealand cows. What I thought I would do is just reinforce this prove that you heard Kim talk about. Ken and I have done sessions on these. It basically is taking our expectations for income, specifically pre-tax income in the future, and dividing that by the enterprise value. So you're basically accounting for the equity or the stock capital in the company, the debt situation with total liabilities, and you're making an adjustment for cash in the checkbook. So in the case of A2 Milk and how you get this relatively high number, this is among the highest projected return on value. You can see the numbers here. You have a situation where they have more cash in their checkbook than they have in total liabilities. That doesn't happen very often for companies. And the stock price has gone from the area of $9 or $10 down to $5. So again, strong balance sheet. You can see that right here. And this is just numbers been driven up pretty high. So that's why it's so high on that preceding slide. What do? They basically have milk from cows that have theorized have a better nutritional value with this A2, and I can't go into the chemistry. Hugh could. Maybe we'll go deeper into this if we continue to accumulate, but they just think it's a good nutritional idea, and it's actually been borne out in the opinion of many Chinese experts, and that's infant formula that you see there on the right. So they've had a pretty good experience with expanding outside of New Zealand into Australia and China and into the United States now. But they have had a bump from COVID. And everything about the business remains strong. The critics would say they haven't done enough to tell the story, and probably haven't done enough R&D and that type of stuff to really help tell the story. And that's an area that they probably need to work on. They have a lot of cash. Here's an opinion from Value Line. The stock is trading at right now at $5.46. Value Line checks in with a fair value of $8.66. You saw that on that previous slide. Here's a look at the business model analysis for the company. Again, this is a company that has very limited data. It's tough to find data on this company, and most of the analysts have run screaming from any forward-looking projections. So it is kind of a tough sell on getting a lot of information. They do have approximately $1 billion in sales, and they are cranking away at 25 to 30% by that red trend line, fairly reliably. They are currently predicting that they're going to come in slightly below that, perhaps somewhere in this area for 2021 for the year ending in June. And that is just driving the investing world crazy, that they're going to maybe come in slightly less than that red trend line. Oh my gosh, it's Armageddon setting in. The milk is sour. Oh my goodness. All of the estimates that are coming in on the company, was it 20? They're now talking 18 to 19. Again, the analyst community is treating that as some type of absolute disaster, and they are going to have a bit of a shortfall thanks to the world economy and economic conditions. So maybe a little bit less PE, but this story continues to unfold, and I just find a fairly interesting situation. Again, very, very oversold, possibly undervalued. And here's that situation again. They've got a heck of a lot more cash in the checkbook than they do in liabilities. And in fact, it's gotten better over the last 6 months. So hopefully this trend will continue, even if it does flatten a little bit. I don't think this is a company to run from. Could the thesis change? Could their predicate or their basis for this A2 milk being a superior, potentially superior nutritional product, could that change? I don't know. Perhaps, but the story is currently intact the way that I see it. One of the things that we do know about companies that are selling products like this, shelf space matters. And I look at this roll call of places that they have shelf space in. I've actually gone and checked a number of these to see if I could find this product, and I did so successfully. So yeah, they do have shelf space. So they are selling it, and people that have problems with milk and lactose conditions do report that they seem to be having a pretty good experience. So even a little bit of success and storytelling and whatever could go a very long way.
And it tastes like milk, Mark.
And it tastes like milk. It's good. It is important.
Because it is milk.
Like milk. So here's your situation. I mean, the story hasn't changed. The stock price is way down, but I say we go in and basically I'm going to take a stubborn swill of milk and go for this one. And then I would just like all of you to, take in the picture of the little young ladies and the father and son there on the sunset, and know that if you don't vote for this company, you're voting against these people. So shameless
pandering. Okay.
No, I think the story's intact, and people that I've talked to that, like Ken says, it tastes like milk, and they basically probably need a good marketing muscle and spend a little bit of that $500 million that's in their checkbook, and things could get very interesting. So with that, I will turn it over. We will throw a little more milk on the fire also. And Ken, I think we can take it away for our audience poll.
And I think it's up right now, Mark. Folks, use your mouse, if you have a touch screen, use your finger, and give us a vote. Which one do you think is the most promising out of the group? You can choose none of the above. And we will place an extra $1,000 into the portfolio for the audience choice as well. We'd love to have 85, 90% of you voting. We're up to 76, 79%, 81%. So come on, give us a few more votes here and we'll get a real nice cross section of our audience. We have over 300 attendees this evening. So there we go. We jumped to 88%. I'm going to 89, 90%. Okay, we're going to close the poll down. And I will share the results. And the results show, what do they show? I have it hidden on my screen here. Oh, the results show that Regeneron is going to get another $1,000. DXC came in second at 33%. A2 Milk. Mark, you convinced 15% of the audience, and Hugh, they just don't like Gilead right now. I don't know what's going on with it.
Oh, it's that unconventional flatlining that is tough to take.
But either that, or there's a lot of folks in the audience that maybe lost money the last time this happened with Gilead, so still mad at it. So I am going to hide the results right now. And Mark, if you want to go on to the next slide.
All right, I do want to give a shout out to Dennis Roman. He said that we were Dean Martin and Perry Como. I just want to thank Dennis for not saying we were Dean Martin and Jerry Lewis, because that's kind of special. Just want to point out that we are doing the bull sessions Tuesdays at 2, and we do archive the presentations. We'll show you in a minute. We keep them at YouTube. I'll pull up a slide here, Ken, so that you can cover the COVID cancellation, successful investing 3. The May roundtable is a month out, and we will be adding more information here. But Ken, why don't you go ahead and talk about what we're going to be up to in a couple weeks?
Yeah, we've run 2 of these already since COVID began. This will be our 3rd go-round. We're going to have the same format. We're going to run 5 classes, with one of them being our esteemed stock panel, which is giving you some great ideas over the times that we've been in conference. We're going to do a small company session on Wednesday, May 12th at 2 in the afternoon. On Thursday, May 13th at 1 o'clock, a brand new class called From Theme to Target, how to identify actionable items. We're going to start with broad themes that people don't have any problems identifying broad themes, but taking them down to actual actionable ideas is another issue. So we'll talk about that and maybe give you some hints and some examples. Thursday, May 13th at 2 o'clock, we're going to run a portfolio design and management. We'll touch on some of the more important things. We'll talk about, can you do this really in a simple way? And we're going to answer, yes, you can. You can very easily if you'll abide by a few simple actions and try to keep your emotions out of the portfolio designing part of the whole thing. Success comes fairly easily after that. Sai's going to do a Friday 2 p.m. class on stacking the deck in your favor. Great ideas for how to put an SSG together that gives you a little bit of an edge as you prepare the document. And then Friday at 3 o'clock, 8 of our most distinguished stock pickers from around the country will gather to give you their best idea and then a second idea in a special lightning round. We look forward very much to hearing what they have to pick. And as I said before, the kinds of stocks that have been picked in our last 2 successful investing conferences have been nothing short of spectacular. Here's the pick coming from last May, and you can see that return averages 92%. 1 triple, 1, 2, 3, 4 doubles, almost 5 doubles, and just a great relative return for a set of stocks coming from, at that point, I think there were 6 individuals picking stocks back last May. Some great ideas. We don't know if any of them are buys today, but they certainly, we thought they were all buys last May. 16th when we made the choices. We'll do the same again, and we hope to give you at least a handful of great ideas. We're not going to guarantee everyone's a winner, but come listen to us talk about our best ideas at that particular point in time. The information has gone out to our mailing list. If you have not gotten information on the COVID cancellation conference and we're naming it Successful Investing 3, then drop me an email, kkavula1@comcast.net, and I'll see that you get a mailing that gives you all the URLs that will allow you to register for the conference. That's kkavula1@comcast.net.
All right, here's just a quick reminder that all of these sessions, all of the roundtables are available in archive form at YouTube. If you just search for Manifest Investing, you will find when you click on videos, if you click on this tab right here, you'll find a number of videos going back, including all the bull sessions and the roundtables. And in fact, if you want to start preparing for those sessions we mentioned a couple weeks from now, here are the sessions from November and then last May. So the stock panel did extremely well in May. They did well in November, but I didn't. So please don't look at those until I have time to recover a little bit. So this one here, you're not allowed to look at this one yet. I need time to recover. All right. So with that, Ken, I think we are at the end. If you want to take us down and we enter our cooling off period.
Yeah, if you want to close the recording down, Mark, we can take a few questions. We don't have a lot, but I think we have a couple of interesting ones that we would want to maybe talk to the group about again, all right?
Thanks, Kim and Hugh and Ken, and we appreciate it. Thanks to the audience for attending, and we hope you enjoyed it. Thank you very much.